So what you have here are a bevy of different things that are cash or cash equivalents or something else. Now, the cash and cash equivalents line item on the on the balance sheet is always the most liquid asset. And it's important to know that when you see that line, it's not all paper currency, right? So understanding what is cash, what is considered truly cash by an accounting system, what is incorporated with cash as a cash equivalent on that single line item, super important. There will be a couple of other things embedded in here that don't fit either cash or cash equivalents, and we need to know how to account for those as well. So the paper currency, that is definitely cash, right? That's the rawest form of cash. But companies are not likely to keep around a lot of cash on hand, right? Some businesses need to, like your typical retailers have a cash drawer, but even they are routinely putting it into a time deposit safe and then taking it to the bank for deposit. They should do that, very readily because again, just having cash on hand is not a great idea for a business. It sets you up for fraud, for robbery, etc. Right? So that one is definitely cash. Now, this one says as a part of its debt covenants with creditors. Real quick explanation on that. Creditors mean people we borrowed money from. These creditors will often have certain covenants on these agreements, which would state, something like you have to keep a current ratio at this level. You need to have X dollars of cash set aside, restricted in a separate account until the debt is resolved, right? That's kind of a collateral arrangement so that the lender can take that money if we default, right? So covenants are just assurances to the lender that they will be paid. Well, one of these, it says Frankel has $500,000 set aside in a bank account stipulated by creditors, and it's bound by legal restriction. And that legal restriction is very important. Legal restriction means that we have a change in recognition. Now, understand that the word recognition implies that a dollar value or account on financial statement will change. And you're thinking maybe, well, what's the alternative? I mean, everything we're doing changes the dollar values of accounts on financial statements. Okay, well, sometimes there's just needs to be disclosure. So recognition versus disclosure. Disclosure means no change on the financial statements, but change footnotes to the financial statements. So what is the difference? Well, I mean, I think about my youth as a student when I'd be reading a text and I'd see a footnote and I would think, well, that's great. That's something I don't have to read. Right. And yes, at the undergraduate level, that's a very safe assumption, right? Changes as you start getting up there. You want to start reading footnotes eventually because they're important. If you're a financial analyst, you're not just going to go buy the 4 to 6 pages devoted to financial statements that are published by the company's annual report. If you're going to get an in-depth analysis of the company, you need to consult the footnotes to the financial statements as well. Now, we realize that not everybody has enough time to involve themselves with reading the 30 to 60 pages of footnotes that are highly technical accounting speak, right? So when the FASB really thinks something is important, relevant, and material, the change is a recognition. They want something to change on the financial statement because all eyes are on those 4 to 6 pages, that high level summary of what's going on at the company. If the FASB is not as concerned about a transaction, right, then the standard might say there needs to be a disclosure and a change to the footnotes. They understand that not everyone will see the footnotes. It's okay when the transaction is not as it's significant, important, and material to the company. So there's a very big difference between the two, and it's one worth understanding. In the case of a legal restriction, got to change recognition. If this were just voluntary, right, not legally restricted, then we would just need to update the footnotes. We could still count this as cash if it were voluntary. But because of that legal restriction, it is no longer cash, nor is it a cash equivalent. Undeposited checks, right? So we got checks on hand that someone sent us, haven't sent them to the bank yet. These are not deposits in transit, they're checks on hand. And let's say that we had some checks that were not deposited, totaling 30. 10,000 of that 30 are dated after 228, so those are post dated. The remainder are prior to 228. Those are definitely cashable, right? Because if we took, say, if the post date was March 10th, if we're reporting on February 28th, we can't take that March check to the bank. They will not honor it until the calendar date arrives to the date of the check. So the post-dated checks are receivables, and the cashable checks are simply cash. And then we have investments in bank accounts, right? A money market account with check cashing privileges. A money market account is similar to a savings account, tends to earn higher yield than most savings accounts. And also, they come with check cashing privileges sometimes, which is beneficial because you really don't want to write, you don't want to withdraw money frequently from a savings account. It'll trigger fees. So we have some money in a money market account with check cashing privileges. The fact that it has those, the check cashing privileges, makes it more like cash. If it was then without check cashing privileges, then it would be a cash equivalent. Uh, Again, discussed in the foundational videos a little bit more. Savings account, that's cash. The balance of our checking account after reconciliation, well, we just got that amount and it was 153,825. This is cash. Right now we have some investments. Treasury bills originated on January 1st of 25. They're going to mature on March 20th of 25. Now, got to be when deciding whether an investment should be a cash equivalent, a short-term investment, or a long-term investment. The first thing I do is look at the origination and the maturation. So I'm looking at the time interval between these two periods. If this is less than 4 months, then this is a cash equivalent, not a short-term investment. The idea is that it is so close to maturation that there is little interest rate risk. So we can record it as a cash equivalent. Now, if you look at this one, it doesn't pass the 4 month test. It was written on September 1st of 2024, and it's going to mature on April 1st of 2025. How long is it between these 2 months? Well, it's about all of September, October, November, December, January, February, April, March. 8 months. So this is not a cash equivalent. Even though when we're reporting cash and cash equivalents, it is only a month out. That doesn't matter. It's the difference between when it originated, when we originally invested, versus when that investment matures. And since that's 8 months, it locks it out of being a cash equivalent at all times. It'll just be, excuse me, a marketable security, which is the term most companies use for short-term investments. And then finally, we have an investment that originated on January 1st, and it's going to mature in 2 years. Well, that 2 years puts it beyond what a current asset would be, right? The max on a current asset is 1 year. So this is a long or a non-current. You could call them long-term, but the more preferred term is non-current investment. And when I say preferred term, I'm just telling you what most companies use when they report on financial statements. So remember, look at the original, the origination of the investment and how far that out is to the maturity. That gives you the first test. Is it a cash equivalent or not? The second test then is to determine how far from the date of classification is the maturation. If it doesn't pass cash equivalent, then we're looking at, well, is the maturation within a year? If it is, then it's a current asset, a marketable security. If it's not within a year, then we have a non-current investment. All right. So now we just need to separate these guys out and determine how they would be reported on the balance sheet. So I would just create a holding spot for all of my cash accounts, one for my cash equivalents, which we didn't have many cash equivalents this go around. So my cash, we have $11,600. That's the paper currency. We also have the checks that were dated prior to 228. So 10,000 were post dated. That means 20,000 of that were cashable. So these are prior dated checks. We have, let's see, that is not cash. The restriction, we got the deposit of the ones that we can deposit here. Then we're off to these pieces. The with chest cashing privileges, that is cash, $720,000 money market account. We have the savings account, 420. And then we have the balance of our checking account after reconciliation, 153,825. So those are all my cash pieces. The commercial papers are marketable security. The last investment is a non-current investment. All told, that's $1,325,425 of cash. Now cash equivalents. Where were my cash equivalents? I only have one. Here, the T-bills of 16,000.